Barbara. So this is a panel on sustainability risks, responsible fiduciary, and investment infrastructure. I must say a lot of the points I think this panel is going to make may have been made in earlier panels, so we're just going to underline them and hopefully expand on them and so on. I want to talk about, before we go to the panel, just a couple of slides that I've got. Boy, I see they've got me identified here as Common Fund and Kepos Capital, and I have a lot of affiliations. When we were asked to raise our hands earlier, I raised it for almost every category. But what I want to talk about is something we did at the World Wildlife Fund a couple of years ago. We faced, as you can imagine, the same concern that many of you are probably facing, that folks would point the finger at us and say, well, what are you doing in your portfolio? We have a very small portfolio, by the way. We call it a reserve fund. It's only $200 million. But the trustees of the World Wildlife Fund, and I should make clear, this is the U.S. Chapter because we're a global organization, but we're talking about the U.S. We're very concerned and upset about climate risk, as was I, by the way, and I am the head of the investment committee. And so we sat down about 2 years ago, in fact, and said, what should we be doing differently in our endowment? And one of the ideas on the table, obviously, or perhaps not obviously, but it was obvious to us, was should we divest of all fossil fuels? And the concern that I had as head of the investment committee was, you know, the solution is very clear. We have to create appropriate incentives to reduce emissions. That's what we have to do as a society. And that creates a set of risks for those that own these fossil fuel reserves. I was very impressed by the analysis that Carbon Tracker had done and so on. And so I said to the committee, but the issue is when you think about stranded assets, all fossil fuels are not the same. It's very clear when you look at the data that coal cannot be burned. There's, you know, a huge amount of coal. It's the least efficient and so on of the fossil fuels. On the other hand, natural gas is much more efficient and may play an important role in the interim. And in any case, I think the message that we want to send, and perhaps more important than what we do in our portfolio, is that we reflect our mission here as the World Wildlife Fund to protect ecosystems around the world. The message we want to send is that we have to create these incentives to stop burning fossil fuels. In other words, we have to price them. And what I liked about the focus on stranded assets, and by the way, I love that everyone here today is talking about stranded assets. In those days, it was kind of a new concept. I read about it first maybe 2.5 years ago, which isn't to say it was brand new then, but it first came to my attention in a white paper that was written by Generation Investment Management. And there was a program at Oxford on stranded assets, and stranded assets is certainly a broader concept than just emissions. But the focus on stranded assets is good because what strands assets is creating incentives to reduce their usage. And so rather than making a moral argument about fossil fuels, which, by the way, a lot of us use fossil fuels every day, that's not the issue. The issue is we have to price these, and we're not pricing. We have to reflect the economic externality. And so let's create a statement about stranded assets. Let's eliminate them from our portfolio. And so we brought in our consultant, it was Cambridge, and said, we'd like to get rid of the stranded assets in our portfolio to reduce the risk. And by the way, the reason I'm telling this story is primarily because it's a story about removing obstacles to doing something. Because the first thing that Cambridge said to us, and those of you who are in the consulting community won't be surprised, they said, oh, it's much too expensive to do that. They did, I would say the first step they did is they said, let's identify how much you own. Well, it was less than 1% of our portfolio. I guess we were gratified to see it was so tiny, and we defined stranded assets as coal and expensive sources of oil like tar sands and Arctic drilling and so on. And we at the World Wildlife Fund have been arguing against Arctic drilling for a long time for obvious reasons. And they said, well, you know, it's a very small amount, and it's distributed throughout your portfolio. It's in your private equity, in your hedge funds, in your public equity, and you'll have to disrupt the whole portfolio to affect a tiny proportion. Now, we said, well, that's not a good enough answer. What's the best way to address this? And so they helped us come up with what I think was a very simple and clever, if you will, solution. They said, all right, we can overlay the portfolio. Rather than go to all your underlying managers and force them to change what they're doing for you, we can hedge those stranded assets by entering into a derivative instrument, a total return swap. It's now, derivatives come in all different flavors. Some are very complex. Some are actually very simple. And this is just a very simple way to sell the assets in your portfolio. Rather than going to the underlying managers, you just enter into a contract where, from an economic point of view, you say to a counterparty, and in our case it was Deutsche Bank, we would like to enter into a contract where we pay you the total return on an index and you pay us the total return on a different index. And every month we'll settle up, and if our index made more money than yours, you pay us some money, and if yours made more money than ours, we pay you some money. It's very simple. And what it does is it allows us to, in effect, sell those stranded assets. Now, it raised a lot of questions. How do you define those indices? And this first slide kind of indicates in a very simple way how it works. We said, all right, we don't really want to sell exactly necessarily what the assets are that we own. We have some private equity that owns some coal company somewhere. Might be difficult to sell that because it's private. But we can hedge it by selling a publicly traded coal company. So we created an index of coal and an index of tar sands. And we said, let's take 3/4 coal, because that represents approximately what we own, 1/4 tar sands, and let's call that an index of stranded assets and sell it. And then we'll receive, and we decided, a broad market index, the S&P 500, because we don't want to reduce our equity holdings. We want to just create a very simple formula to hedge our stranded assets and otherwise not change the portfolio. What I really liked about that suggestion, which came from Cambridge, was that it's a very simple economic story that's very easy to explain and understand. We're basically making a bet, if you will, that stranded assets are going to underperform the market. Now, that's a bet I like. As a fiduciary, I think that's going to create a positive expected return. It also is hedging my risk, and perhaps most importantly, it's aligning my portfolio with the mission of the World Wildlife Fund, because we're trying our best, along with a lot of other people, to create appropriate incentives to reduce emissions globally. If we do that, that's going to hurt the valuation of those stranded assets. So if we eliminate that risk from our portfolio, we're aligning the portfolio with our mission. So all those excuses why you might not want to do something, we can take them off the table. It's very simple, it's very cheap, and it's very effective. And so we did that. The one thing I will tell you we didn't know was how well that would perform. I thought it would have a positive expected return. This is a graph of the cumulative performance of that stranded assets total return swap. It peaked about, a month or two back at over a 50% return in less than a year and a half. Probably the best trade I've ever done in my career, by the way. Who would have known? And I'll tell you why I was a little skeptical. When we went into this and we put the swap on, it took us about 6 months to get it implemented, but when we put it on, coal had underperformed the previous 3 years by 16% annually in the previous 3 years. I thought, well, it would have been nice to do it 3 years ago. I'm not sure it's a great time to do it now. Well, it wasn't a bad time to do it now, and I don't know if you can see this, but I've kind of annotated the performance. It hit a minimum. We were down 5% in May of last year, and that's when Stanford announced that they were going to divest of coal. And then, and I thought that was very good, except that Stanford never said anything about stranded assets. I think they understood why. I think the students who recommended it and the faculty who supported that, and even the Stanford Management Company all understood stranded assets. I'm not sure the Board of Trustees did. They just said it's the right thing to do. So they did it. But that started, I think, sent a signal, because they weren't the first university or institution to address this issue by any means, but they were the first big one, really, a very respected, large institution with a big endowment to say, we're going to get out of coal. And then I think another very significant event was back in, I guess that was August or late August or early September, Yale University announced their decision, which from a bit of a distance seemed like a negative. They said, we're not going to divest of fossil fuels. But they bent over backwards in making that announcement to say, but we understand the reality of this risk. We understand it's going to change the entire economy and the valuation of assets. And so we're going to make the appropriate adjustments in our endowment. And then the head of their endowment, David Swenson, who's one of the most respected investors in the world, he wrote a letter to all of the external managers of the Yale Endowment, and these are some of the most respected investors in the world for sure, saying, look, this is real, this is he didn't use the word existential, but he said it's a very significant threat to all of us and to the future, and it's going to affect everything in the economy, and we want you to take that into account in all of the investments that you make for Yale University. And you can kind of see on that graph at that point this stranded asset swap, which is kind of, to me, a mark-to-market of expectations of emissions pricing. Some people think, well, it's not going to have any effect. Someone talked about, how you try and capture a falling knife. You can't capture a falling knife. And it's not about when emissions are priced. It's about what are investors' expectations of whether this is going to happen in the future. And investor expectations have clearly been going up. I would say everyone now, it's a matter of when and how. And I can't tell you when or how, but I can tell you emissions will be priced. I'll also tell you it's very likely, because I come at this from a risk management perspective, and when you see there's a risk coming at you, I wish I had time to tell you the story about the tanker that nearly killed me about 3 months ago, but you don't ease onto the brakes. When you see something coming at you, you hit the brakes hard enough that you expect to solve the problem. And what that means is we're going to see significant emissions pricing. It's going to come soon. Don't try to catch that falling knife. You should prepare for that now. And really the interesting question to me is what are these stranded assets? For us, it was coal and tar sands. If it's the oil majors, and I'm not an expert in the energy business, and it's obvious it's going to hurt the coal companies. It's not so obvious what it's going to do to natural gas, but I would guess it increases the demand for natural gas. And what it does to the oil majors, not so clear. I'm thinking it might be pretty bad for the oil majors. It really depends on the price of oil. And what we've seen, and I'll kind of just finish on this note, is last November, Saudi Arabia said, we're going to start we're not going to cut back, is what they really said. And why wouldn't they cut back? In the past, they've cut back because they may realize that oil that's sitting right there, they can pump as much as they want, basically, is potentially stranded. So I don't want to keep it in the ground if it's going to be stranded. I want to pump it out. If Saudi Arabia starts maintaining a low price for oil, the oil majors are not going to be worth nearly as much as they think. So that's something for everyone to think about. And frankly, the Bank of England, the SEC, the Fed, all the financial regulators who are worried about financial risk are starting to worry about if people realize this. Actually, as a risk manager and a finance guy, I'm not so worried about that because these things get embedded in prices smoothly over time, as you've seen. So, and who's to say what's embedded in there now or not? I think there's a lot of expectation that emissions are going to get priced, but not as quickly and as high a level as people expect. So that's the bottom line on stranded assets. Now I'm going to turn over to my panel, who are going to talk about a number of other things. And my first panelist here is Alice DonnaSelva. Is that the right pronunciation? And she's with Prime Buchholz and Associates.
Hi, so I was asked to speak to you. It sounds a little loud to me. I was asked to speak to you about how we would start with a client who was interested in investing in line with their mission, basically. There's a lot of different missions out there. Some is to divest, some is to have more of a better social impact or environmental impact. So I'm just going to talk more broadly about that. The first thing to look at is your investment policy statement. But as I look at all those dots over there, I'm not going to spend quite as much time on that as I thought because a lot of you have passed that point. But I do want to just make the point that you need to incorporate your mission into your investment policy statement. It is a guiding document for us as investment consultants, and it's a guiding document for you. And if you don't take some time to think about your mission and how you want to implement your mission in your portfolio, then you end up taking several steps backwards after you've started. So you really need to lay that groundwork. It's very important to get all the stakeholders who you think might have an interest in this mission and might have an interest in the portfolio involved if you can. I would say the spectrum runs from families who it's just around the table and they're hashing it out, and that tends to be the easiest group. Not always, I realize. I've heard from many that is not as easy as I thought it was. But to the spectrum of private foundations, then private colleges, and then I'm sorry to say, for those students who are here in the room, the hardest thing is the public colleges, is what we found, because there's a lot more stakeholders and there's a lot more people you have to involve in that conversation. But the conversation should be had. So that's the next piece. You get your mission into your investment policy statement, and then you think about what do you have for resources and what efforts do you want to put forward in promoting your mission. Some foundations decide that they're using their endowment to raise as much money as possible, and they're going to use grants. They understand grants better. Some move on to a discounted loan. It's a below market rate loan, but it's like a recyclable grant. You give money to someone, you make a loan, they might give you 2% back, but you get your money back, and then you can invest it in something further to further your mission. And then many want to do something in their portfolio. More and more clients are coming to us saying, how can we align our portfolio with our mission? They might do a combination. And then I think a lot of times we're remiss in ignoring shareholder activism. There's a lot of groups here. There's Ceres, there's an investment network for climate risk, several groups, As You Sow, who can help you if you want to actually take what you own and engage companies. There's managers also who do that. So think about the resources and time you have to put towards that, whether you need other networks to be helping you. And I'm not doing so good with the button. Oop, I did too good with the button. So the next thing to think about is what approach do you want to take? So for those of you who are doing the fossil fuel divestment, you want to exclude stocks. In many ways, that's easier because separate account managers can take your list of stocks that you don't want to be in and just not invest in them and invest elsewhere. Best-in-class investments, those are managers who are saying, okay, we don't want to be out of the energy industry, but we want to be with the companies that have the best environmental record, the best record of supporting their employees, offer the best wages, have a diverse workforce, have a good safety record. And so there's different managers out there who will look for the best companies in a class. That will likely reduce your fossil fuel exposure. It doesn't always eliminate your fossil fuel exposure if that's what you want to be doing. So then there's a number of other things. Having a separate donor pool is a solution that some of our colleges have used. So they have alumni on the board who have history in the oil industry, and they're not going to exit, or you're maybe hitting your head against the wall against them exiting. One option for students to consider is pushing for a separate donor pool. For those donors who want to be fossil fuel free, a separate pool is set up. And those pools are fossil fuel free. So those are some options. Thinking about how much of your portfolio you want to be fossil fuel free. Are you willing to forego hedge funds in your portfolio because their transparency is less? And that's a discussion you can have with your investment consultant. So the next thing, once you've got it in place in your investment policy statement, and you're clear sort of how you want to proceed and how much of your portfolio and what angles you're going to be taking, is to really get an idea of your exposure to whatever it is that you don't like. If you're not going to take a best-in-class approach, for some of the people here, it might be if you're a health organization, alcohol and tobacco. If it's invest, divest, it's fossil fuel divestment. If it's a faith-based client, sometimes there's life ethics values that come up. So I hear over and over again, we can't do anything because we have commingled funds and there's no transparency. And I don't understand that question. So we, as your investment consultants, can take your commingled funds and we do a look-through. We do it for our quarterly reports for analysis. You can get a report very similar to this and know exactly where your exposure is, know what stocks are in the portfolio and how much exposure you have. Next step we phrase this as picking the low-hanging fruit, but that sounds sort of negative. So it's really doing what is going to be the most effective and most efficient first. And so this is actually something we put together with a foundation here, who's represented here, a matrix to divide out your portfolio on what can be replaced with environmentally or socially conscious funds first. And so don't try to just wholesale go in and think you're going to revamp your portfolio. Take what you can do and do the most effective thing. So I'm going to give one example because I know I have 1 minute left, and of what I see as a low-hanging fruit. So most endowments and foundations religious organizations, consultants recommend some sort of indexing in your portfolio. You have a Vanguard index, institutional index fund, or a Vanguard total stock market fund to represent the index. That's where, if you're a fossil fuel, if you want to divest, that's where your fossil fuel holdings mostly are. Your active managers, they're not seeing value there either. So it's going to be largely in your index fund, and there are index fund replacements available, and there's more coming. So that's often a good way to start, and you'll see that as the top, on the top dark green section here, on what can be replaced first. I'll stop there because I know I'm short on time, and turn it over to Keith, who's going to talk about fiduciary responsibility. You may have to skip to.
Do you want me to start?
Sure, go ahead, Keith.
Okay, I'm here basically just to try to address the situation for those of you who've had experience with your lawyers saying you can't do this. This is a breach of your fiduciary responsibility. And typically, I think when lawyers hear a question about can we do this, they automatically translate that into, well, they're asking me how to avoid liability and how to take the lowest common denominator approach, basically. I don't think that's really what people are asking about here. I think what you're asking about is what are the fiduciary duty principles intending to encourage and promote for us to do. Again, most lawyers that have worked in this space are familiar with the traditional view of fiduciary duty, which is just make as much money as you can over a short-term basis and try to do what everybody else is doing because that's the lowest common denominator, the safest thing to do. I call that the Lemming standard because what it does is it actually encourages herding around the same investment strategies and its same investment approaches, which actually adds to volatility and risk in the markets. So I think from a market perspective, it's a very, very unhealthy approach to fiduciary duty. The good news is, if you look at the screen, the holy grail for what fiduciary duty is for foundations and endowments is the Uniform Prudent Management of Institutional Funds Act. And if you look at, if you get your lawyer to actually read what it says, there's a lot more balance in the fiduciary duty standard for foundations and endowments than most lawyers think. It doesn't require a diversification across the entire universe of investments. There is the ability to reduce your diversification to the extent that you think there's reasonable basis for doing so, excluding certain types of investments because you think they're risky is entirely consistent with fiduciary responsibility as long as you've gone through an approach where you've thought about it and are not doing it basically because it's a belief or a bias that you have. It has to be sort of gone through a process kind of that's reasonable and related to, again, the goals and charitable purposes of whatever the mission is that is associated with the funds that you're investing. The other thing that I think is really important here in the standard is that it's a fact-based standard. It's not it requires a fiduciary to sort of do an investigation of the facts to make sure that you're not making decisions based on a bias of somebody that may be from a fossil fuel company and has a behavioral reason incentive to basically not come to grips with the risks that might be posed by fossil fuel investments and other kinds of issues. It basically requires you to sort of seek advice, and there are lots of people in the room here, and is you've seen lots of approaches that you can use that are very reasonable and address the kinds of issues that we're talking about. I think that the other real issue, which is sort of covered by the Uniform Act, is the time horizon in which you're looking at trying to maximize your investments or get your returns. It does not have to be over the quarter or over a year. It should be tied to the mission and the goals and the purposes for which you're trying to generate returns. Unfortunately, I've worked in the pension and institutional investor community for over 30 years, and when I started in the business, we used to primarily focus on investment strategies that paid off over a 3 to 5 to 10 year time period. Now I rarely hear mainstream investors talking about something that extends beyond the next quarter or the next year. And that is not a fiduciary requirement. I think that the legislative intent of the Uniform Act is something that you can direct your lawyers to on this slide. It basically makes it very clear that the Uniform Act, which has been adopted in nearly all states, is intended to have an investment strategy tailored to the charitable purposes of the organization. And this is really something that's unique for nonprofits. Another concept, I think, which is critical here is that fiduciary duty is a very dynamic concept. It's not tied to a single approach. Some of you may be old enough to recall that there was a time when it was considered to be imprudent to invest in stocks at all. There was a transition in interpretation and understanding of fiduciary duty, which took place in the 20th century between, I think, probably the 1960s and 1990, where we transitioned from a legal list approach to what's a prudent investment to modern portfolio theory. I think we are sort of transitioning again into a new understanding of what fiduciary duty principles require. I think there are other markets that are further along than we are. You can see here that the UK Charities Commission has been much more forward-thinking in providing specific advice that charities are not required to maximize financial return, and that they should consider furthering their charitable purpose, and not only look at their program grants, but also try to integrate the investment program and their supply chain and who they use for service providers into trying to achieve their charitable goals. I really like the Sustainable Accounting Standards Board as an example that's trying to fit identifying material ESG standards on an industry sector basis to U.S. Securities Exchange reporting requirements. George Serafim and some other researchers at Harvard recently did a study. This is one of a number of, this is one of my favorites, but this is one of a number of the reports that basically have found that if you look at and build a portfolio around material sustainability issues on an industry by industry basis, that it substantially will outperform less sustainable companies. And I like to cite the Heron investment policy because I think they've done a really good job of sort of translating their investment beliefs into observing the fiduciary duty to have obedience to their mission and to serve a public purpose and trying to evaluate all of their investments through a lens where they're looking at whether the investments are consistent with mission and applying the full balance of the Uniform Act fiduciary standards. So look forward to questions later.
I'm Christie Zarkovich, and I'm with Perella Weinberg Partners. We represent almost entirely endowments and foundations, ranging from the Rockefeller Brothers Fund, who we're very honored to be working with in their efforts to integrate sustainability throughout their portfolio, but we also have several endowment and foundation clients that are not at all interested in this discussion. So we are, really see a wide range. And so wanted to talk about, I'll try not to be repetitive, but I think it's really clear that there is not one model for success in integrating sustainability into your portfolio. I think everybody has made that very clear. I also think hopefully people feel very comfortable that integrating sustainability does not violate your fiduciary duty. It actually is probably a requirement now. But what it does violate fiduciary duty, or where there can be questions, is when you change your due diligence standards for your managers, and maybe when you change your asset allocation in a way that is only reflecting sustainability objectives versus the multiple objectives of an endowed portfolio. So I just want to hit on a few of these in a little bit more detail. I'll try not to get too technical, but there are big differences in the asset allocations of even within endowment and foundations. And so implementation of sustainability really varies quite a bit between people that may have more traditional or conventional long-only equity and fixed income portfolios. People say those are 70-30, 60-40 portfolios. And those that have embraced sort of the endowment model that are heavily allocated to alternative investment strategies. So for our clients, this equity discussion with divestment that is largely focused on long-only equities, it applies candidly to 30 to 35% of their total portfolio exposure. So it's important. It's an important part of your portfolio. You can have those discussions, but you have to be thoughtful about how you're going to integrate this in to your total portfolio. And these are where the issues of commingled funds and transparency often come up. And I can't agree more with Alice. It is your OCIO or consultant's obligation to be able to look through those commingled strategies and understand your exposure. So you shouldn't feel like you have to get out of commingled products to implement and incorporate sustainability. You just really need to be aware of what you own. I also think that as you move towards sort of these more complex endowment model portfolios, there are lots of legacy assets and private capital investments for our clients that are moving to divest candidly, where we have seen most of their fossil fuel exposure is in private equity investments that they chose to make 10 years ago. And so to get rid of those, you're going to secondary markets. There are large sort of secondary discounts to sell these LP interests. So there are some very, you get into very technical, nuanced, issues as you try to implement through each asset class. And so I think a lot of times, I'm not saying our industry is terribly receptive to this, but I think what they are often trying to say to you is there's a lot of sort of technical nuance in how you implement this, and you're overlaying sort of the technical nuance of what divestment means to each organization, what sustainability means, what are your values. And so it's a complex discussion. I think it's one that everybody should be having. And I think, though, that this is just circular into what we've heard all day. There's not one right answer, and there are a lot of very different solutions. Going the wrong way. And then on manager selection, the other discussion we have heard and is common when you talk about impact and sustainability is the rapidly increasing number of products available to investors. And I think that that's good, and it is true. But sort of a sustainability mandate or new manager is just one criteria. And we live in a world where operational due diligence and the operational considerations for firms are increasingly important when you're an institution. And so candidly, what we see is a lot of smaller managers in this space and it is harder depending on who you have, how you're implementing what your investment policy statement says, for subscale managers to invest in the resources that are just required now, sort of frankly post-Madoff and some of the headline risks. And so that doesn't mean that the investment strategies aren't very sound, but we just live often in a different institutional world where finding managers that have strategies and have the robust infrastructure is difficult, and you just have to be thoughtful in your manager selection. So we have spent a lot of time trying to look at sustainable strategies, but also looking at strategies that just don't have offensive assets. And there are a lot more of those than I think get discussed. I feel like managers often get put into a good or bad camp. There are a lot of strategies, sovereign bonds or asset-backed debt, where they probably don't have anything offensive and they can serve a very critical diversifying role in your portfolios. The other thing in this space that we hear a lot about and we have a lot of deal flow is direct investments. And again, sort of in the due diligence requirements, I think what we have found is that it is often not understood that when you're doing direct investments versus going into funds, from a due diligence and fiduciary perspective, you really need to take on and do the same level of due diligence a general partner would in a fund. You need to hire those technical resources that would understand that alternative energy generation plant. You need to understand the legal consequences, and that becomes very, very expensive for many in institutions, which is sort of some of the chicken and egg that you hear, that we don't have products, and part of it is because for good or bad, we have a lot of intermediaries in this process. I am going to skip this, but really you have to look at sustainability by asset class and by strategy and think about the details. It's not as simple as sort of what does this do in your global equity portfolio. And then I just want to conclude with some of the lessons learned. We have found with our clients that have moved down this path that when they start with sort of high-level target projections, we end up implementing those, and then we end up with a lot of questions afterwards about how do we actually define fossil fuels, where do we feel about carbon sequestration technology. So as many of those questions, values-oriented mission objectives that you can sort of discuss within your organizations before implementing into your investment portfolio, I think will make implementation so much more successful. So I think that those are all complex issues, but those are sort of really the values that you're trying to integrate. And so rather starting with your portfolio and percentage targets, start with what your values are, and I think that will give your investment consultants and OCIOs a lot more information so that they can actually effectively implement what you're trying to do.
Great.